Hello and welcome. My name is Felicity Caris and I'm the Head of Communications at CPI Energy Finance. Today, CPI Energy Finance launches its new report, Understanding the Impact of a Low-Carbon Transition on Uganda's Planned Oil Industry. This analysis is part of our Global Sovereign Risk Programme, exploring the impact of the climate transition on public finances and financial stability, and follows on from our work in South Africa published in 2019. First, we'll hear from David Nelson, CPI Energy Finance's Executive Director. He will introduce our programme of work on climate risk, transition risk management, before Matthew Huxham, a principal at CPI Energy Finance and lead author of the report, takes us through the main findings from the analysis. The presentation will last around half an hour, followed by a Q&A session for Matthew and David. I would ask that you add your questions to the Q&A box that should be visible at the bottom of your screen. A copy of the report will be sent to all of those who registered today, but if you do have additional questions after this session, please also feel free to follow up with David, Matt, or myself. And with that, I will hand over to our Executive Director, David Nelson.
Thank you, Felicity. I would just like to start with a very brief introduction of CPI. We have been around since 2009, about 80 analysts in offices around the world. Generally, we are set up into three discrete practices. One is climate finance, one is land use, and the energy finance practice. Energy finance that that you're speaking to today are primarily involved in looking at the financial risks and financial impact and upside of a global climate transition, and also with specific expertise and projects in terms of energy industry restructuring and the impact of or the options and opportunities around an energy transition within the climate dilemma. If we can go to the next slide. Our climate transition work began in earnest really in around 2012. CPI founded in 2009, but in 2012, we began work on something called the New Climate Economy. This was a revision of a report that was done in 2006 to look at the economic impacts of climate change. We focused on the impacts on the global financial industry, and included in this detailed asset-by-asset valuation models of fossil fuel and commodity assets around the world. One of the things that became an interesting point from this analysis is that we realized that if done properly, the energy transition portion of it, and potentially the entire climate transition, need not cost any more. There need not be any additional economic or financial impact on the global economy. In fact, there could be an upside, but that the risks, and there would be winners and losers, and the risks associated with the climate transition were very concentrated on a few players. So there was very general upside, but very concentrated losses. And we began to realize that there was a financial stability issue, that the essential problem around climate change was more around, can we manage the risks in the transition rather than the absolute cost? By 2015, we began to work with the EBRD and others, but EBRD in particular, because one of the things is where we had done valuations of assets, what happens to an oil field or a coal mine under a transition when prices change and production change. We had not yet really been able to allocate that risk between governments and workers, investors, companies, and it turns out that is a very, very essential element to understand the risks, because the nature of the specific assets and how they are owned and allocated really affects what not only what the risks will be, but what the implications are for global financial stability. Moving on to, by 2017, we were working with the World Bank and a group called the Advisory Finance Group, which was a group of around 30 to 40 senior treasury development banking officials from around the world who met under the guidance of the then CFO of the World Bank to understand what were financial stability problems that the development institutions needed to be looking forward at, and financial institutions in general. There were a number of corporate players involved as well. The charge that we were asked to was, if you were thinking about the IMF and the World Bank and the IFC, should we be thinking about sustainability in general and climate change in particular as metrics that you need to look at in assessing the financial stability of individual sovereigns? How do you think about sovereign risk, sovereign debt in the face of a risk that may happen if the world decides to transition to a low carbon, perhaps following in line with the Paris agreements? With that group, they decided to commission us, including the French Development Agency, which was part of it, the Development Bank of Southern Africa, and the AFG, to have a deep dive application of our modeling and analysis to South Africa. And through 2017 and 18, we worked on that. One of the key areas that began to develop there was not just looking at the transition paths of how this flows through from the original contracts to what happens after you look at defaults and strategic measures that strategic activities that the individual players will take to spread that risk. But we also began to identify that there were a whole series of actions that South Africa can do now, as well as the development community, to reduce their risk, to make sure that the risk, which is mainly driven in South Africa's case, and we will see in Uganda's case, mainly driven by players outside of South Africa, that is, the global transition is more important to the risk than the South African transition. But there are a series of measures that South Africa should do now in order to avoid that and avoid or mitigate the risk. Including these are, should you be looking at changing your investment strategy to ensure that your sovereign credit rating and that your economy is robust if the world does go to a low carbon transition. What we want to avoid in this case is countries that continue investing in a business as usual pattern and therefore become at greater risk and have greater losses because they've invested extra money in this transition and therefore have reasons to actually try to slow or delay the transition because they have more at risk as a result. After the South African work, we have begun to expand our risk analysis work into additional countries. Again, with the French Development Agency, the Rockefeller Brothers is providing support here in Uganda. We are currently expanding to our work in Indonesia, Morocco, Shanxi province in China, Uganda, India, Colombia, and we've been in discussions with France, Australia, the UK as well to extend our work. We're thinking about the longer term about how we should be thinking about sovereign transition ratings. We need to look at developing probabilistic scenarios around the models, but we can discuss that in another discussion. But finally, we've also been looking at developing hedging and risk management tools for sovereigns and corporates. One of the things, and investors, one of the things that we have found early on is that the underlying models we have created not only help us think about the sovereigns, but help us look at the risks at a particular company level and a particular asset level, and begin to help us develop plans for how a company should manage their risk, or how an investment portfolio or a sovereign wealth fund should manage their risk in the face of this. And so there's a whole other side of this analysis that feeds into that. The two of them clearly fit together as we can help investment portfolios and countries reduce the risk so that we can actually accelerate the transition going forward. That is where we stand. I would like to welcome you and welcome Matt to talk specifically about our implications, or the implications our modeling have shown with respect to Uganda and the potential to develop the oil industry. I think that there are a number of very interesting findings that he'll put forward, not the least that our analysis doesn't necessarily say that there is no value left in Uganda, but it does point to the fact that there are very concrete measures that need to be taken before the decision on whether or not to go ahead, to make sure that the development of these resources doesn't create additional risk with respect to the climate transition as we move forward. Anyway, with that, I will turn it over to Matt, and I will be back around for questions as we finish the workup.
Thank you, David, and thanks, Felicity. Just a few other thank yous before we start. So I want to thank Mohammed Anwar and Owen Strutt, my colleagues who were absolutely key to the analysis that I'm going to share with you today. I'd also like to thank the Rockefeller Brothers Fund for supporting this work, and the Agence Française de Développement for supporting our program in this area. And I'd also like to thank those of you, many of whom, or some of whom are on the call today, who have been sounding boards for us as we have gone along through this process. It's been a weird year for us, as it has been for everyone else, and ideally we would have spent a good portion of the time working on this, going backwards and forwards between here and Kampala, and really engaging in detail with Ugandan officials and the companies involved. And we have had some success with that strategic engagement, but it's ongoing. And some of these parties have very kindly provided feedback on early versions of findings, on drafts of the reports. And it's our intention that today is certainly not the end for what we're doing in terms of engaging in Uganda. Right, so I'm gonna stop my video, otherwise I will distract myself. One sec. Okay, so this is what I'm gonna talk to you about. Firstly, I'm going to give you a bit of information, a bit of background for those who are not that familiar with the situation in Uganda, and for those of you who are more interested in the techie side of things, some of the key assumptions that we've used in our modelling. Then I'm going to say a few words about what has happened to the value of Ugandan oil over the last 6 or 7 years that Uganda's been negotiating with its international oil company partners, Total, China National Offshore Oil Company, and Tullow. Then I'll take you into the question about, we asked ourselves, is Uganda's oil industry still viable in a scenario where the world decarbonizes in line with the Paris Agreement, and if so, under what terms? And then finally, we'll take a look again at the potential benefits and risks to Uganda's public finances in a transition, and review some of the conclusions and recommendations. Right, let's get down to it. So this is what we have been looking at for the last year or so. There's a map there. You can see we have oil resources in green. There's two main developments called Tilenga and Kingfisher, and you'll see there they're on the Ugandan side of Lake Albert. And the story that we're telling today is really mostly about the oil. Probably the majority of it is designed for export markets. And you'll see on that map there that the oil gets collected from the fields, transported to a hub near in Hoima province, and from there would be transported by pipeline to Tanga port in Tanzania for export. And a portion of that oil would then also be refined domestically. Size of the reserves around 1.6 billion barrels. And we expect, if the development goes ahead, for first oil in late 2024. and there's a few assumptions up there that I'm not going to go into at this point, but it's worth stating up front that this is no ordinary oil development. The pipeline that I mentioned, it's called the East Africa Crude Oil Pipeline, or ECOP, is a very long one. Uganda is landlocked, and it will take just under 1,500 kilometers to go from the fields in Uganda to the port in Tanga. And the route that the pipeline crosses is a very environmentally sensitive one. There are, it's an area of great biodiversity with significant forest coverage. There's a lot of, endangered animal habitats across that area, and so and for some of these reasons, the pipeline in particular has become quite controversial. On top of that, the pipeline needs to be heated to 50 degrees because in order to transport the crude, because of its waxy quality. And that waxy quality means that we think that the oil, if exported, would trade at a discount to Brent. And that's in part because it's more expensive to refine than oil without those characteristics. And so it means also that the inland refinery at 60,000 barrels a day, very small in the context of the international market, is also pretty expensive, costing around 4 billion in terms of capital expenditure. So those are really the three main assets that we've looked at. We've got the oil fields, the pipeline, and the refinery. And we've done an analysis basically, and I'll explain using the next slide. What we mean by climate transition risk is the difference in the net present value of future cash flows in relation to an asset, let's say the Tilenga field, between two different climate transition scenarios. And when it comes to oil assets, the two primary variables are production and price. And here I'm showing you the results are the two oil price scenarios that we've used in this work, with BAU, business as usual, and the green line well below 2 degrees C. These are oil price projections that we've generated using our own global crude oil model, which uses Rystad Energy as the principal source of information for supply, and the International Energy Agency with some adjustments as the principal source of information for demand. So we used these prices and production to generate an understanding of the profits in each year that each of these assets would earn. We've also, as we'll come on to in a second, completed valuations in different scenarios. So firstly, and this blue line that I've just put up there is the oil price scenario from 2015, which was the original expected year of final investment decision after licenses were signed in 2013. So we wanted to understand basically how much the value might have changed over the period of negotiation. We also wanted to sense check our work against other low carbon scenarios. So here are two of them up here. You'll see in the light blue, that's the International Energy Agency, that's the oil price curve quoted in the International Energy Agency's Sustainable Development scenario from this year. And then the sort of yellow or orange line is the case quoted by, so it's a $50 real case quoted by Total in October this year in a document that stated that developing the Uganda fields would be consistent with its climate ambition, and therefore implicitly consistent with the Paris Agreement. And it will probably be a question, but we can come into why our numbers are slightly below those as we go along. Okay, so let's move on to some of the key findings. So what we found, to start off with, is that the value of Uganda's oil reserves has declined significantly over the period that the negotiations have been going on. We calculate this, and this is driven entirely by price. We calculated that the value has fallen by more than 70%, or more than $40 billion over this time, and that's driven principally by changes in the structure of the oil market, which have reduced oil production costs. So the shale oil industry is part of that, and also more recently by reductions in long-term demand projections. So this, we assume, is something that is known more or less to all parties still going on in the negotiation, and the current status of the Ugandan oil industry is that the key parties are now, at least in public, gearing up to take a final investment decision by the end of this year. Key agreements have been signed. Everyone seems very positive. But what we'll show you in a second is that the picture is not quite so simple. So from there, in a world which decarbonizes in line with the goals of the Paris Agreement, we see a further 56% or $10 billion of value at risk. And that's therefore overall 88% downside relative to what would have been the case if the investment decision had taken place on time. So these are these values are calculated, as I say, this is a net present value of future cash flows from oil, discounted at 10%. And this is the maximum value essentially that could come from this oil. So as we'll see in a second, that value is only going to be accessible to the parties involved if the risk allocation is right, if the value and risk is allocated between all of the different players in a way that is acceptable to them and their risk tolerances. So, and what that means in practice is that there needs to be enough revenue from the sale of the products from this industry in order to cover all of the costs and then to provide returns to the relevant different sets of investors in line with their expectations. And this chart here is a representation of that I have just said. It's showing the business as usual picture, and this the total area of this chart is the net present value of the total revenue for the industry in a business as usual case. And so you'll see that the revenue first needs to cover the upstream oil costs. But then it also needs to cover the costs relating to the pipeline in purple on the left-hand side, and the costs in relation to the refinery on the right-hand side. And the return element here to international investors in blue is actually a relatively small portion of this. So Uganda, so we need to sell the oil. The oil sold to export will need to be sold at this price in Tanga, and that will need to be sufficient to cover the pipeline costs and returns. The oil sold after refining, so the oil products sold, then need to be sufficient to cover all of the costs and returns related to the refinery, and both need to help to cover the upstream oil. And so the area, and this is important because because we'll show more of these charts effectively, the area here is a representation of the relative different size of each of these costs and returns. And so you'll see there that by far the largest source of profit is Ugandan government profit oil. Another reason why the maximum value is not going to be achieved is because of decisions that have been made. So, for example, the decision to use project finance for the East Africa crude oil pipeline means that some of the value is going to need to be given to allocated to lenders in order to make that economic. The decision to build a refinery, as we see, adds capital cost to Ugandan oil. It also results in a benefit from reducing oil imports, but we'll come on to in a second. It adds cost. And so Uganda has a number of different mechanisms in order to allocate that value effectively, and some of those I've set out there on the left-hand side. Production sharing arrangements being a key one for the upstream assets, also royalties and the structure of the share taken by the Uganda National Oil Company, currently expected to be 15%. And then also there is the structures of the financing arrangements for the East Africa crude oil pipeline and the timing and the size of the refinery. And so what we did in our analysis was to convert effectively what you've seen a few charts back into an understanding of which value goes to which parties in which scenarios. And again, that has been done by building asset-specific economic models using the actual terms of the production sharing arrangements and royalties, etc., where they are publicly available. And what you see here on the right-hand side is a representation of that over time. Again, you'll see that this is the point that I made at the beginning. This is really principally about the oil, and then the decisions in relation to the pipeline and the refinery are auxiliary to that. So let's move on to some of the key findings. So firstly, what we found was that in both a business as usual scenario and a well below 2 degrees scenario, the returns that Total and CNOOC would expect to get from investment in the upstream resources is now not high enough to meet their investment hurdle rates. What that means is that in the business as usual scenario, we compared versus Total's published investment hurdle rate of 15%. Our model shows that they would own only 12% under current commercial terms. In the well below 2 degrees scenario on the right, not only does the return fall short of the investment hurdle rate, but it also falls short of the weighted average cost of capital in red. So if this were to go forward under these terms, and that would mean that the investment for Total would destroy value. And so we don't think that that the companies would go ahead on this basis. And so we're expecting that before making a decision to invest, they would want to renegotiate commercial terms. And anecdotally, it seems like that is ongoing. So what does that mean in practice, a renegotiation? Well, it means one or both of two things. It means that Uganda will or could be giving up a share of value, could be reducing its share of value and transferring it to the international investors. Or it could mean that Uganda is taking on certain risks from those international investors in order to de-risk their stake, or it could be both. And this is this chart on here is just a summary of a small number actually of the different renegotiation options that we modeled using those economic models. And we considered a whole series of options that Uganda might have in order to renegotiate renegotiate the deal. Everything from moving corporate or reducing the corporation tax burden on the upstream resources, from renegotiating the production sharing arrangement, from taking less of a stake in the oil, and then a whole series of refinery related scenarios. And what we tried to do was to find a situation which was going to result in an investment that was going to have a return that was high enough for those upstream investors, was going to have a return that was high enough for those refinery investors, and was going to have enough strategic benefits left for Uganda for them to do it. And not to mention the risks, but we'll come on to those in a second. And we compared this versus, we decided that acceptable was going to be the weighted average cost of capital of 7% that I showed on the previous slide. So what we found here is that, and this is a comparison of the well below 2 degrees before renegotiation, and one of the renegotiation options here with a 10-year corporation tax holiday for the upstream assets. And what we found was that, and we used a 10-year tax holiday, by the way, because that is a concession that the Ugandan government had already made in relation to the pipeline a couple of years ago. So we modeled this out and extended it to the upstream, and we found that potentially upstream investors just about get to that 7% return here, right? Up from 4 to 7%. Still not spectacular, but potentially good enough. But that comes at a cost. So Ugandan government value here reduces by 600 million as a result of that transfer. And that's nearly 10% of the Ugandan government's total share in oil value over the life of the industry. So material in the context of Ugandan GDP and in Ugandan debt levels. Another option would be to cancel the refinery. So what you see here on this chart is that this reddish, actually slightly orange box representing the refinery disappears in this case. And what you see then is that the amount of costs and revenues for the pipeline here in purple get spread across all of the barrels. And that means that the amount of, because the area of all of this stays the same, the amount of value in the upstream business actually goes up in total by 1.8 billion. And you can see here that the international investor returns have gone up to 10%. That seems to be a sort of healthy return over and above the weighted average cost of capital. And even the Ugandan government's share of value goes up in this case. So the Ugandan government's public revenue value goes up by 700 million. So why would you not do it, you might think? Well, actually, this is only a partial picture. There are many reasons why when oil at commercial scale was first found in Uganda, the idea was to build a much bigger refinery actually than the one that they're planning now. And that's because of the benefits that Uganda might stand to bring from enhancing fuel security, and also the balance of payments benefits. So Uganda currently, oil product imports is by far the highest import bill. And all of those products are imported, substantially all of those products are imported through the Kenyan port of Mombasa, coming through one route inland. So significant potential benefits from having a refinery that they would lose if they were to cancel it, but the compensation would be international investors coming in and Ugandan public value increasing. So the conclusion from this is that it might be possible for Uganda to renegotiate, but in all cases, it comes at a significant cost to the country. Right, so where do we stand after all of that? So when you think about what Uganda stands to gain potentially after such a renegotiation in a well below 2 degrees scenario, you can see that the value to the public, so public revenue through profit oil and royalties and the national oil company share, is 60% lower than would have been the case in business as usual. So very significantly lower benefits. And those equate to, from our calculation, $150 per capita in value. So that's net present value over the entire life of the industry. It's not nothing, but it is significantly lower than expected. And there is a real question here about how much of that public oil value actually filters down to the Ugandan population. You know, in particular, thinking that the Uganda's debt to GDP level has risen by 20 percentage points over the last 5 years, partly because of the delay in oil revenues coming in whilst investments are being made. And there is strong advice from the IMF and other parties about oil revenue management to try and ensure that Uganda doesn't spend all the money at once. So significantly lower benefits and uncertainty about how those benefits actually filtered down to the people in Uganda. If it were just those benefits, then you could potentially make a case for Uganda to proceed nonetheless. However, the risks associated with proceeding with the oil industry are also significant, and it's difficult here to value those risks in the same way as we're valuing the benefits, and to do to show an offsetting trade-off to work out whether this is really positive on a net basis. I've set out a few of them there on the right-hand side, and these are both specific to Uganda, but also have broader relevance. So firstly, by proceeding to make oil a significant part of the Ugandan economy, what this does in the context of an accelerating global transition is add risk to the public finances. So I know that there's been a lot of support to the Ugandan government at managing oil price risk, but this is a different type of oil price risk. This is not just volatility, cyclical volatility. This is a secular decline. So that needs to be managed. Then there's the potentially significant contingent liabilities that the government would be taking on in order to bring on these international investors. They could be relating to the Ugandan National Oil Company, for example, potential government guarantees, and potential liabilities for the environmental costs that would arise from this. Then there is the question of what is happening in global financial markets, which are fast evolving on this question. And we see that it's not just with climate transition risk, but with physical climate risk and other environmental related costs. There is a push to price these in. And once these get priced in, then the picture of Uganda's public debt capacity is going to look quite different. So if we take an example from one of the rating agencies or the IMF's Article 4 consultations, a relatively short-term forecast would show that any oil benefits, whether they're lower than expected or not, are a positive thing. But if you take a relatively short-term view, you will miss the risks that Uganda is locking itself into potentially at the time of making the decision to go forward with international investors on a certain amount of terms. And we would argue that you can't consider those short-term benefits without an understanding of those longer-term risks. Because it's those longer-term risks really that are going to reduce or impact Uganda's capacity to bear other external shocks. We've already seen that this has been weakening because of rising debt levels. Climate transition risk will further reduce Uganda's risk-bearing capacity, and that in itself reduces the country's ability then to deal with the physical consequences of climate change through adaptation investment, and to invest in other areas, for example, such as raising energy access. So what do we recommend? There's a whole series of recommendations in our report, which I'm not showing up here, but two main groups, I would say. We would argue that Uganda, and not just Uganda, but they need to urgently incorporate an understanding of climate transition risk into the policy planning. And this affects both the decision as to whether to proceed with the oil industry or whether an oil-led development strategy is the right one. But it also relates to the way that if it decides to go forward, how it manages how it manages this risk. Just put one chart up there to show how the disparity in one of the sources of benefit to the Ugandan economy between the business as usual and the well below 2 degrees. This is from the balance of payments, positive benefits. But you'll see there in well below 2 degrees that the size of those benefits are significantly lower than in business usual, and they last for much less long. So there is a decision to be made both about whether to proceed and about how to manage this. And one of the things that this suggests is that perhaps that a more diversified strategy might be the right one. So, for example, we showed earlier the fact that removing or cancelling the refinery would actually would cost in terms of the balance of payments. Well, actually, there might be alternative strategies to the refinery that would provide the same economic benefits. For example, Uganda's, work to expand energy access and electrification would also potentially reduce fuel demand, and that will be a way to reduce Uganda's import bill. But Uganda in itself is, as I say, is in a difficult position. It is expecting to receive oil revenues in the next 5 years, and it's, you know, when you read the rating agency and IMF and World Bank reports, it's one of the clear positive signs in those reports about the Ugandan public finances. So without an obvious, fully developed alternative, Uganda's not in a brilliant position by itself to turn around now and say, actually, we're not going to do it. And so we would argue that it probably would need some help in order to do this. And since a significant proportion of public finances is provided by external development partners, ranging from the World Bank, which is the largest multilateral creditor to China, which is the largest bilateral creditor, the African Development Bank, and a series of other bilateral European organizations. There is a question here about what is an effective development strategy, and how do they support a sustainable development strategy? And what we found here is that an oil-led development, it becomes increasingly unsustainable as the transition plays out. And then finally, if Uganda does decide to go ahead with this, then there is significant international expertise that they could benefit from through organizations like the Network for Greening the Financial System, to help to give it the opportunity to manage this risk in a way that does least damage to its public finances. Right, so I'm gonna finish there, and then we'll have time for questions. Just a quick recap. So the value of Uganda's oil has already fallen significantly since licenses were awarded. It would fall a further significant amount in a well below 2 degrees scenario. Under current commercial terms, the expected returns for Total and CNOOC don't appear sufficient for them to invest, and so they're likely to try and renegotiate. Any renegotiation comes by definition at a significant cost to Uganda, whether that's an economic or financial cost. And so we think that there is a case for reassessing whether, a strong case for reassessing whether this is the right strategy for Uganda, given lower than expected benefits and higher than expected risks. But we don't expect that they're not in a great position to change all of this by themselves, and so international development partners are going to be absolutely key. Thank you very much.
Great, thank you, Matthew. So now we'll move to the Q&A part of this session. Please feel free to ask your questions in the Q&A chat box. Hopefully you can see that at the bottom of your screen. We do have one question, Matthew, that's now ended up in the answered column. But perhaps whilst you reflect on that, I could turn back to David to perhaps share a few thoughts in summarising what's just been presented there. David?
Sorry, I was on double mute. Yeah, I mean, I think, as we're going forward in this is very much a risk management exercise, and as we've said, the value of this has shrunk remarkably. There continues to be other, as Matt said, continues to be other benefits in terms of balance of payments, but of course there are other alternatives around balance of payments, including looking at increasing renewables. Of course, there's a big mismatch with respect to renewables in terms of the timing of delivery, and the Ugandans will also say that the oil is producing things like lubricants and such. So that also lubricants and chemicals. So there's much more than just energy being produced out of this. And so the timing about when you replace it will create risks, but it is not something that can't be managed and understood. I think the key that you have in all of this is that with the value being small, and by the way, if there are further delays, one of the things that the report will bring out more, further delays to this project will actually decrease the value further, as more of, particularly under the well below 2 degrees C scenario, as more of the revenues come at lower cost future timeframes. So really, the issue here is to take another look at this, to look at the alternatives, and understand whether the reduced value that we have here is really worth the investment going forward. And then, as Matt said, to create systems in the negotiation that really look at all these sources of value and decide whether or not to go ahead and how. And I think that is really very critical. But with that, I'll turn it back to Felicity for the questions that we have out there.
Thank you. Yes, we have some interesting questions coming in now. Matthew, I don't know if you want to respond to Melinda Janke first, who asks, how do you value energy security from oil compared to energy security from 100% renewable energy? Which is not necessarily something that our analysis looks at, but you may have a thought or two on that.
Yeah, sure. Happy to answer that one, and it is a very good question. So in the Ugandan, I mean, the answer to that question will differ in different contexts. In the Ugandan context, we have clearly a situation with a very large proportion of the population that doesn't have regular access to clean energy or electricity, and so and it's one of the key things that we think that the Ugandan government could focus on in order to reduce their oil imports and many other benefits, of course, as well. On the face of it, energy security from 100% renewable energy is obviously preferable in terms of security than energy security from being self-sufficient in oil. But the path to get there has significant challenges. We hope that there will be significant investment in scaling up those resources, but as we've seen in places like Kenya, for example, there can actually be unexpected issues with the transfer to renewable energy in itself. For example, the significant imports of equipment into the country, which then impacts on the balance of payments and the currency, the guarantees that the government has put out in order to encourage international investors in renewables, which started to weigh on its own balance sheet. So getting to that renewable energy future, I think, is absolutely key, and I would agree that it has more security, but it requires a well thought through path, and I'd be happy to discuss that further with you separately if you'd like.
Sure, thank you. There was a follow-up question from Melinda about how we define sustainability in the oil sector. So that may be a fairly straightforward question to answer.
How do we define sustainability? Well, I mean, I don't know if it was a reference to what I said about sustainable development. What I meant there was that the volatility that could come from investing in the oil sector, particularly making a big bet on the oil sector, may mean that it's not a sustainable form of, or it's not a sustainable economic development strategy, and that a more sustainable one, in relation to both physical climate risk, environmental risks, and transition risk, would be a more diversified one.
Yeah. If I might on that interject, because I think that there was a little bit of a confusion of terms, because there's the difference between overall sustainability and in one case financial sustainability. And one of the worries that we have with the oil industry is that, beyond environmental sustainability, as it might be financially unsustainable. That is to say that if you have sudden oil shocks and oil price shocks, or a much more rapid transition even than we have here, what you could find is that the debt itself, you will not be able to pay the debt that was accrued in making the investments in the first place. And so there is a risk, and this is what the ratings agencies will see when they begin evaluating the consequences of a transition on Uganda. There is a risk that the amount of debt that's accrued to invest in these projects could make, or it will make, Uganda much more dependent on oil prices, international oil prices, and therefore lead to a financial stability risk that could happen. Now, it could be that the upside of that risk is worth the downside, but what we're talking about in management of risks is identifying those financial risks and then either hedging them or creating contractual solutions such that we know that if the transition does occur, that it doesn't undermine the overall financial stability of the Ugandan economy.
Thanks, David.
Thank you.
Shall I just respond to the other questions?
Yes.
So there's a question about physical risk, and how do we, which we don't include in our analysis or in our quantitative analysis, and how do we factor that in, or how should we factor that in? I think that follows on quite nicely actually from what David was saying. So when we talk about physical risk, we generally we're referring to the damage that would occur from the physical consequences of global warming. In Uganda, that's specifically going to be extremes relating to floods and droughts. And the cost of preparing the country for that physical risk is, which by the way is another risk that Uganda is not in control of, obviously, because it's caused by global greenhouse gas emissions. That has a cost which may well also fall on the government balance sheet. And so if the government is going to need to invest in what we usually call adaptation measures in order to protect itself, then that's
Hello? Did we lose Matt?
I think so.
I mean, I can, while he's gone, I can continue with that question. Matt was talking about the costs of physical risk and what they imply for the sovereign finances, and I'll ask where I think he was going. If you are a country and you are trying to protect your financial stability, you need to be thinking about all the places where you need to reserve against unexpected events. And so the interesting thing about physical risk is that you are worried about an event such as a drought or storms when they happen and what impact it will have on the finances. But beforehand, if you are a sovereign rating agency, what you have to say is, okay, what will be both the insured and uninsured costs of physical climate change, and how should I adjust the amount of debt or what the debt rating of Uganda will be, how much they can borrow, when we have to make sure that they have the capacity to cover these physical risks as they happen. And so the question here is, how much of the risk capacity will a sovereign lender or should the Ugandan government in its case reserve for the transition risk they have, at the same time as how much how much capacity will already be absorbed by the accelerating physical risks and the need to reserve financial capacity within the framework of what your sovereign rating will be due to the physical risks of climate change. And so those two fit very neatly together in trying to determine what is the relationship between physical risk and transition risk and how they affect the overall finances of the country and the sovereign.
Thank you, David. It seems that Matt does have some technical issues on his end. Oh, he is back.
I'm back. Sorry, that was rather dramatic, wasn't it?
Great.
Thanks for David for
David's just rounded off that last question. We have a question from Hatem Chakrun, which you perhaps might want to pick up now, Matt, if you can see it in the Q&A box.
It's in the Q&A, isn't it? I can't but I remember what it was. I think the question was about positive externalities.
I can read it if you like. It says, how do you value positive externalities of the oil project on neighbouring population livelihood?
Sure. Okay. So there's obviously both positive and negative externalities, but focusing on the positive side of things. So So I just hinted really on how that public oil value might be distributed. In fact, Ugandan legislation passed in 2015 would suggest that 6% of oil royalties be transferred to Ugandan regional governments, and of that 6%, half is due to go to the municipalities, immediately around the area of the oil industry. And so, from memory, of the total of 6.7 billion of value to the Ugandan government in a well below 2 degrees scenario, that means something like $100 million over the 20 plus years of the industry going direct to the municipalities. Now, again, the extent to which that money translates into positive externalities in terms of service provision and the like depends on the the management of that, the effective spending of that money by those local organizations. And I read a few academic papers in this suggesting that unfortunately the sort of revenue management or spending capacity of some of the local provincial officials and municipalities is not great. So obviously that needs to that's an important proviso. Then there's the question of jobs, I guess, is probably and probably other ancillary economic activity that might be connected to those jobs. I mean, and inevitably there would be jobs, and probably more jobs in the country, and certainly more and higher quality jobs if the refinery went ahead. But it's very uncertain really how many of those jobs persist beyond the construction period. Most of those will be in the construction phase. It's also uncertain how many of those, particularly the higher value technical jobs, would be available, or whether they would be brought in by as contractors by the investors. And then the question of the ancillary economic activity, well, there certainly would be some. It's very hard to put a number on that, in part because, unfortunately, when you look at the ease of doing, so the World Bank has an ease of doing business ranking. Uganda is pretty low on the list, so the actually very low on the list. So the ability of the sort of local entrepreneurs to take advantage of this, might be stymied by the environment. So I want to be clear, there absolutely would be some positive externalities, but what we've seen, and we haven't been able to put a number on it for the reasons that I've suggested, is that they are extremely uncertain, and so that would be something obviously that the Ugandan government would have a better handle on.
So if I can just give a very quick addendum to that answer, I mean, this is one of the big conundrums of really all resource extractive industries, because the question on one hand is, what would be the positive externalities if we were to invest the same amount of capital? But of course, and clearly, if you could invest those in producing goods, and in producing goods that then had a value on international markets, you would be in the same position. The problem, of course, is that because oil provides a good that has a readily accessible market, that there's a known demand, it makes it easier to secure that investment in the first place. So oil tends to be a very simple solution to looking at how we can generate that. But there are alternatives. If you are investing, tens of billions of dollars, or at least $5 to $10 billion, there should be also considered, when you're talking about the positive externalities, what would be the alternatives of investing the same amount of money, and how can we make that investment in a way that it is secure, such that it can actually attract foreign investment rather than just through the sale of oil. So there are alternatives. We need to think about what would the alternatives be with the same sort of investment if we went forward, and whether or not, what is the difference between the job creation and the positive externalities of the two scenarios.
Great, thank you, David. I mean, we are over the hour now, but we do have one last question from Luis Marara. As I said earlier, if you'd like to follow up with us separately following this session, then please do get in touch. But I will just leave Matt to answer this question from Luis.
Sure. Okay. Thanks, Felicity. The question here is about whether the potential transition risk in the oil sector is large in Uganda compared with other countries. So there are a couple of relevant factors here. One is the cost of Uganda's oil, and another one is the fact that it is a greenfield industry and you're building new infrastructure. So Uganda's oil is not that. Just the cost of getting it out of the ground once the facilities are put in place is not that high, and that means that Uganda, we found in our well below 2 degrees scenario, where there was 56% value at risk, the volume at risk, so the amount of production that Uganda wouldn't sell in that case that they would sell in business as usual, that was only 19%. So Uganda doesn't lose much volume potentially in a well below 2 degrees scenario, and there are other countries where the oil is much more expensive to extract, which would lose out worse in volume terms. So I think that and we're just in the position now of doing this work in more and more countries, but I would be surprised if this was a unique position. One thing that which doesn't help the picture for Uganda is the fact that this is a greenfield development. If these facilities were already up and running and the investment had already been amortized and the debt had been paid off, then Uganda would be in a better position. But in this case, because Uganda still needs to recover the capital cost of all of these facilities, it also makes the oil a bit more expensive, and there'll be other considerations in relation to debt potentially that come into this. That is a very relevant consideration for other countries considering oil or fossil fuel commodity-led economic development strategies right now. We haven't done the numbers for Mozambique, for example, but that would be clearly another example of a country with relatively weak public finances betting big on commodities. There are others as well. I'd be happy to talk to you separately about that, about specific cases.
Yeah, and just to summarize, high cost undeveloped oil can very often, can very often lose more than all of its value, become worthless because it won't produce. Low cost already developed oil will only lose on price and not on volume. Uganda is somewhere in between, but probably towards the expensive. So it's losing more value, definitely not unique, and not even the worst off.
Okay, thank you very much. We are well over the hour now. So thank you very much for your interest in our work and for your time today. The recording of this webinar will be made available on our website alongside the report itself. So if you have any further questions, please do reach out and get in touch with us. We'd be happy to follow up with any other questions you may have. So thanks very much for your time, and I wish you a very good day.
Thank you.
Thank you, everybody. Speak to you soon. Thank you.